Part 2 to the Cambridge IGCSE Paper 21 from the May-June 2020 series. I covered the first 3 questions in the part 1 of this video, and we'll be starting from question 4 on this one. Alright, so he says, Rani is a trader. Her financial year ends on 31st March. She provided the following information about her 3 types of inventory. Alright, and then he's given you the inventory items, their number, the cost, selling price, and selling expenses. So, and in part A, he's asking you to calculate the total value of her inventory. All right, so if you've read your book or your notes, whatever, you must know that whenever you're valuing your inventory, you have to value it at the lower of either its cost or its net realizable value, the lower of either two of these, right? So because he's not giving you the NRV in this question, you just have to calculate it yourself first and then figure out whether the cost is lower or the NRV is lower. So I've written down the headings as usual, and I'll calculate it with you. So the net realizable value is the selling price minus whatever expenses you actually had to go through to sell it, right? So in this case, he's given you the selling expenses per unit. He could have given carriage inwards, etc., etc. Sorry, carriage outwards, etc., etc. But in this question, he's just given you the selling expenses, right? So to calculate the net realizable value, you have to subtract 2 from 20 in this case for the item A. So this is going to be 20 20 minus 2, which is going to give you $18. That is your NIV, right? So if you look here, the NIV is $18, and the cost is 17. So the lower of cost and NIV is the cost in this case, which is $17. So we're going to value the inventory at cost because it's lower of the cost and NIV, right? So to value the inventory, we're just going to multiply the cost by the number of units, which is going to be 17 into 110, which is going to give you $1870. $1870. All right, and we're just going to do this with the other 2 inventories as well. B, he gives you selling price 19 and selling expenses 1, so subtract them. 19 minus 1 is $18 again, and the cost here is also $18. So it doesn't matter what you choose, either the cost or the NRV, they're the same in amount. So just multiply the 85 by 18 multiplied by 85, which gives you $15.30. All right, and then same thing with C. The NRV is going to be 16 minus 2, which is $14. I forgot to write the dollar sign there, but you shouldn't be forgetting that. All right, so $14, right? And the cost is 15. So in this case, the NIV is lower than the cost. So we're going to use the NIV to value the inventory. So in this case, it's going to be 14. The NIV is 14, and multiply that by 90. So 14 into 90 gives you this gives you 1260. All right, and then to the total, he asked for the total value of the inventory. So you just add all of these, the inventory items A, B, C, the total, you add their totals, and when you add them, you're going to get $4,660. So that is going to be your answer in this case. That's 4 marks. All right. And then he says, Rani later discovered that she had an amount of inventory of item D at excuse me, 31st March 2020. This inventory originally cost $1660. She considered this inventory to be obsolete. All right. So when he says obsolete, obsolete means that the inventory is, let's just say, destroyed, or it has no value, right? So the value is actually going to be 0 because he says it's obsolete. She considered this obsolete. So the cost actually was $1660, but now it's worth $0, right? So in this case, the value, or the new value, or in this case the net realizable value, because this is now what it's worth, right? It actually cost you 1660, but now it's worth 0. So the NRV is going to be 0, right? So in part B, he asks, explain to Rani how the value of the inventory of item D affected the profit for the year ended. Alright, so the inventory is an asset, right? And it comes in the cost of sales. But in this case, the inventory actually has a new value, which is $0, right? So the inventory would be recorded at its net realizable value of 0 exactly. So if it's on 0, then it's not going to have any effect on profit, right? If it was, well, maybe if it was sold above the cost, maybe 1700 or 2000, right? So then it will have increased the profit because you gained out of that, right? So that is going to be the answer for part B. Part C, right? He says, advise Johnny whether or not she should stop purchasing item D to avoid having obsolete inventory in the future. Justify your answer by whatever. Okay. So he's asking you whether or not she should stop purchasing item D to avoid having obsolete inventory in the future. So, as you know, he said above that the inventory of item D of Rani actually became obsolete. So, if it became obsolete, then if you keep buying it every year, then if it becomes obsolete again and again and again, then the money you paid for it will actually go to waste, right? The inventory will turn out obsolete, it won't give you any profit, and the money you bought it for will actually go to waste. So she will avoid losses due to wasted or obsolete inventory, and she will decrease the storage costs. If you're keeping the inventory in some warehouse or anywhere, so that is going to cost you, right? So that will, if she stops buying it, these are the advantages to stop buying item D. He asked that, all right? So if she stops buying item D, she will not have to pay storage costs for it, right? So that's another advantage. And a disadvantage would be that customers who buy products in bulk and groups may stop buying from Rani altogether. All right, so she actually sells 4 items here, A, B, C, and D. So if somebody always comes up and buys 10 items of A, B, C, and D, he might not be getting D, so he just might stop buying all of them from Rani, right? And he might go to someone else who has all 4 available, and he may buy all of them from somebody else, because if you buy 3 of them from Rani and then product D from someone else, that's going to be a bit of a hassle. So why not just go to somebody who has everything and buys everything from one store, right? So that is going to be a problem. So if somebody buys a lot of things from Rani, he might just go to somebody else. Another disadvantage would be that due to no availability of product D, her sales would decrease, right? So if she's not selling a product D, her sales will decrease, obviously. And then it would be risky to keep only 3 items in your inventory, as the future demand for product D may increase, obviously. If, for example, in the future people come up and say that, oh, item D, we need item D, and the demand for it in the market increases, so that is going to be bad, right? So you technically just gave that away uh, by keeping only 3 items in your inventory. So that is another 5 marks. You have to give your your what's it called, yeah, your conclusion as well, right? So in my opinion, I would say that because I've written down more disadvantages, excuse me, I would actually say that she shouldn't stop buying item D, right? Because she would be giving away a lot of sales, and if the demand increases, then, well, that would be a bummer for her. Right, so there's another part here. Right. So he says Rani earns advertising income by placing advertising boards in her shop window. The following details relate to her advertising income. Alright, so the advertising is income for her. Because she has advertising boards. Alright. On 1st April 2019, Rani had received $420 in advance, and $300 was owed to her. Right, and then he says during the year ended, she received payments totaling $6,000, and she wrote off $300 due to her. That is going to be a bad debt. because write off the amount due to her, right? So somebody didn't pay her, so she just decided to ignore that and she wrote it off anyway. So that is going to be bad debts. And then he said on 31st March 2020, that is the end of the year, she received 500 in advance and 400 was owed to her. All right. So if you don't know the exact format for these, because these are dealing with, we are going to be dealing with prepayments and accruals in this part. So if you don't know the format for this or the logic to this, I have a pretty simple way of memorizing it. Because we're going to be dealing with the what's it called, the advertising income. So if it's an income account, you can just memorize this, that the prepaid amount brought down is going to be over on the credit side. The bank amount, or whatever you paid or whatever you got, because it's an income you got in the bank, right? So it's going to be on over on the credit side, and the accrued carry down is also going to be on the credit side. Right. Similarly, if it was an expense account, then the prepaid brought down, bank, and accrued carry down would be over on the debit side. Right. Income is credit in nature and expense is debit in nature, so you have to keep that in mind. And the obviously on the other side, this would be prepaid carried down, accrued brought down, the opposite of these. And then to balance this out, we would actually balance this off by using the income statement value. But let's see what happens here. Right. So he says here, all right. So on 1st April 2019, she had received. This is the start of the year. The 1st April 2019 is the start of the year, right? Rani had received 420 in advance, and 300 was owed to her. Owed to her, right? So as we saw, the prepaid brought down and the accrued carry down are both on the credit side in this case. So the prepaid brought down in this case is the at the start of the year, the prepaid in advance is prepayment, right? So it's going to be 420, which is going to be 420 over on the credit side. This is the prepaid amount, or in advance payment. And then accrued carry down, which is going to be right over here. Or actually, let's just go this way. All right. So, and 300 was owed to her, right? So this is accrual at the start of the year. So that would be an accrual brought down, right? So that is over on the debit side of an income account. So let's just write that down. Accrued carry down, which is, how much is it? It is $300, right? Right. So similarly, if the prepaid brought down is over on the credit side, the prepaid carried down. Oh, I messed this up actually. All right. So the prepaid carry down is actually going to be over on the debit side, right? It works oppositely. Prepaid brought down over on the credit side, prepaid carry down over on the debit side. And the accrued carry down is over on the credit side, and the accrued brought down is over on the debit side. So you just have to memorize that. You can take a look at this and memorize it, or if you have some logic to yourself, you can also use that. All right, let's fill this in. The prepaid carry down is over on the debit side, so this is going to be 500 in advance at the end of the year. So write that down, 500. And then $300 was owed to her at the start of the year, so this is the accrued brought down. We did this. All right. And then there's yeah, at the end of the year, 400 was owed to her. So this is accrued carried down, right? So accrued carry down comes up on the credit side, so that's going to be $400. And then he says that Rani received check payments totaling 600. So uh, she received $6,000 on in her bank, right? Check payments. So we have the bank here. The bank in an income account is always on the credit side, right? Whoops. Alright, so she received $6,000 in her bank, and then he says that she decided to write off the amount of $300 due to her. So somebody owed her $300, but she didn't receive it. So she decided that this should go on the bad debts because somebody owed her, but they didn't pay. So that is going to be a bad debt. So $300 bad debt always goes on the debit side for the the credit side for the income account, right? So this is going to be $300 on the credit side, because this is, bad debt is an expense. So $300 debit over on the bad debts account and credit on the advertising income account. All right, that is going to be the double entry. And then when you balance this off, because you have the brought down and the carried downs, you can just total these off yourself. And because you have to write the brought downs for the next year, just total these off first. So this is actually going to total, this side is going to total $7,120, and then this side should total $720 as well, 7,120. So the balancing figure in this case is going to be the income statement, because you have the carry downs anyway, right? So you have to balance this off using the income statement. So when you balance this is going to be $6,220, and that is going to be the charge for income, advertising income, for this year. And don't forget to carry forward the carry downs, which is going to be 400 over here and 500 on the credit side. So this is a bit tricky, I must admit, but the thing is that you'll get this with practice, especially if you know your logic, or you know the format to this. Is going to be really easy for you. Alright, so in part E, he says, explain to Rani the effect on gross profit of recording sales of inventory as advertising income. Right? Right, so listen to this carefully. He says the effect on gross profit of recording sales of inventory as advertising income. So sales of inventory is technically sales, right? So just bring in your mind the format of the income statement. So first comes sales, and then you subtract your cost of sales from it, right? And then when you subtract cost of sales from the sales, that gives you your gross profit, right? But in this case, he says that the sales are included in below in the other incomes section, as the advertising income. So the problem with this is, if there's no sales up here, the gross profit is going to be, well, it's going to be a gross loss, because there's nothing to count against cost of sales, right? So in this case, yeah, the gross profit will be understated because there's no sales, because sales of inventory is used to calculate the gross profit, right? So whereas advertising income comes after gross profit. So if there are no sales, there's obviously there's only going to be cost of sales, which costs you. So that's an expense. So that is going to go against your profit, and that will result in a loss. All right. So question B. Sorry, question 5. All right. So he says MPT Limited prepares its financial statements to 30th April each year. All right, and then retained earnings, the general reserve, the brought downs. These are the brought downs, and then during the year ended 30th April, this is the year end. The following took place. All right, the company made a profit of. All right, so he's giving you some stuff here, right? And then he's in part A asking you to uh, calculate the retained earnings of MPT Limited at 30th April 2020. All right, so he's given you the brought downs of the retained earnings, right? So that the brought down is actually $14,000 for the retained earnings. The year ended is 30th April, and he's asking you the retained earnings at the year end. All right, so retained earnings. All right, so you have $14,000 here at the start of the year. So let's just write that down. At the start of the year, you had $14,000 in your retained earnings account. All right. And then he says during the year ended, the company made a profit of $28,000 after charging debenture interest, right? So uh, the the profit of the year is actually added into the retained earnings account. You should know that, all right? So we're just going to add up the profit for the year, which is going to be adding $28,000. All right, and then he says a transfer of $5,000 was made to the general reserve. So if you know your companies well, then you should know that the retained earnings account is actually used to transfer money to the general reserve. So we're going to subtract this $5,000 from the retained earnings account, right? So that if you're just going to subtract $5,000, this went over to the general reserve. So this is going to be added to the general reserve, which is $35,000. But he's given you, all right, he hasn't. All right, whatever. So this is done as well. So in part 3, he says a dividend of $4,500 was paid. No other dividends were payable for the year. All right, so you paid $4,500 as dividends. Dividends are paid from the retained earnings account. You should know that, obviously, if you've read the book or whatever you use. So we're going to subtract $4,500 from the retained earnings at the start of the year. And then when you total that up, you're going to get at the end of the year you'll end up with $32,500 in your retained earnings account, right? So you made a profit, you add that to the retained earnings at the start of the year, you made a transfer to the general reserve, and you paid out dividends. So both of these are going to be subtracted from the retained earnings account because they were used to be paid from the retained earnings account, right? So easy 3 marks there. And then, oh, all right, so in part B he says prepare the statement of financial position. All right, so he's asking for the balance sheet here. So I've written everything down. Obviously this is not going to be given to you. Everything in red is actually I wrote it down. So this is fairly simple. All you just have to do is just write the values. So I'll write them with you here. So let's start. All right, so you should know the format for the balance sheet for this though. So he's given you the non-current assets. Let's see. He's given you fixtures and equipment, which are non-current assets. Motor vehicles are also non-current assets. And then inventory is current asset. Bank overdraft is technically an asset, but in this case this will come in the liabilities, the current liabilities section as well. All right, current asset, sorry. And then the trade payables, which is a current liability. Trade receivables is a current asset. Provision for doubtful debts, this is going to be subtracted from the trade receivables, right? A debenture is a non-current asset, non-current liability. Non-current liability. And ordinary share capital is in the equity section. But do not forget that you also have your retained earnings and your general reserve. Where is it? Yeah, general reserve that you have to put into your equity section. All right. So, writing all of this down, you have fixtures and equipment. So he's given you the book value for the fixtures and equipment, which means that you don't have to take care of any depreciation, which is easy. So $150,000 for the fixtures and equipment, $150,000, and then the motor vehicles he's given you as $60,400. All right. So you add them up later. So this is going to total here 212,400. All right, and then in the current assets section, you have your inventory, you have your trade receivables, and then you have to subtract the provision for doubtful debts from your trade receivables, right? So writing all of this down, the inventory he's given you is worth $31,000. $31,000, 500, 31 and five, $31,500, and then the trade receivables are given at what is this? 30,000. I made a mistake here. All right. All right. So the inventory is a current asset. He's given you the inventory valued at $30,330. All right, and the trade receivables he's given you is $31,500. But do not forget that you have to subtract the provision for doubtful debts out of them, out of the trade receivables, right? Because they're expected not to be paid. So he's given you doubtful debts of $630. So you subtract that, and when you do that, you get 61,200, the total of these the current assets. And when you total both the non-current and the current assets, you're going to get a total assets of the, what is this, $273,600. All right, so 273,600, that is going to be your total assets. So you have to hope for the best that the total equity and liabilities also total to $273,600. All right, so running them down, ordinary share capital he's given you at $150,000. So write that down, 150. All right. And do not forget, because he hasn't given you the retained earnings and the general reserve down here, that doesn't mean that you don't have to write it in the balance sheet. If he's made a reference to it, it has to be on the balance sheet. All right. So you calculated the retained earnings at the end of the year. That is $32,500. So you can just write that down in front of the retained earnings, $32,500, and then that's a zero. All right, and then you have the general reserve, which is $35,000 at the start of the year. But he says during the year ended, a transfer of $5,000 was made to the general reserve, which means that $5,000 were put into the general reserve. So $35,000 in the general reserve at the start of the year, and then you put in plus $5,000, which is going to give you a total of $40,000, right? All right. So $40,000, and that is going to total. That is going to go 232 to 500. All right. Yeah. So this is going to be the equity total for this. And the liabilities, actually the 5% debenture he says over here, is for $20,000. So put that in, uh, what is this? Yeah, $20,000. And then you have your trade payables, and then the bank overdraft that you need to take care of, right? That those come in the current liability section. The payables are given at 24,900, and then the bank overdraft is $6,200. And then when you total all of this you're going to get, this is what, $20,000, and then this is going to be 31,100. And when you total all these three, you're going to get 273,600, which is going to be the same as the total assets. And if they balance out, you mean it means that you solved this question correctly. All right. Right, so in part C, he says, state why it is not appropriate to use the general reserve to repay the bank overdraft. Alright, so the general reserve does not always contain money in it, alright? It's sometimes you just put right, so the general reserve has limited uses, right? You should know that. It's used to pay legal expenses, stuff like that sometimes, but mostly it stays idle, right? It doesn't have many uses. It's because sometimes the money in it is not realized. The problem with it is that sometimes you put money in it that is actually not confirmed to be yours. So for example, you may put some profit in it that you think you're going to get, but you might not get the profit, so you can just cancel that out anytime. So the general reserve does not always have actual money in it, right? It may have some value but not actual money in it, right? So in part D, it says calculate the return on capital employed. All right, the calculation should be correct to 2 decimal places. Okay, so the profit for the return on capital employed is the profit before interest and tax divided by capital employed. So what is capital employed? Capital employed is your total assets minus your current liabilities. This is the formula for the capital employed. All right, so the profit before interest and tax, he's given you that, but he has made a twist to it. He's actually given you $28,000, and that is after charging debenture interest. We need profit before interest, but he's given you the debentures. You can calculate the interest yourself. 5% of $20,000, that is going to be your yearly interest. 5% of $20,000, that is $1,000. That is your yearly interest charge for your debenture, right? So we need he's given you the profit after interest. So this means that the interest has been deducted from this. So we need to add the interest to this $28,000, which is going to be $28,000 plus $1,000, where the $1,000 is the interest of the debenture, which you need to have added, because it's profit before interest and tax. And the capital employed, very easy, you can just copy this from the balance sheet. The total assets are 273,600, 273,600, and then subtract the current liabilities from it, which are current liabilities total to 31100. So 31100, and when you divide both of these, you're going to get 11.96%. 2 decimal places, make sure you give it to 2 decimal places, because he says that, and most probably it has a mark for it, right? So that was really easy, 4 marks as well. In part E, he says the directors are considering increasing dividend in 2021 as a way of increasing return on capital. All right. Advise the directors how the return on capital employed can be increased. All right. So, and he says justify your answer by commenting on both profit and capital employed. All right. Just bring into mind the formula for the return on capital employed. It's profit over capital employed, right? So if you increase the profit, the return on capital employed is going to go up. But if you decrease the capital employed, then again the return on capital employed is going to go up, right? Because ROCE and profit have a direct relation, while the capital employed and ROCE have an inverse relation. Okay, so that's just basic maths. You should be able to do that. So the first point I've written here is actually the ROCE can be the return on capital employed can be, don't write the short forms to this, can be increased by increasing the profit of the company. Obviously, if you increase the profit, the ROCE will increase. This can be done by increasing the sales of the inventory and decreasing the expenses. So if you increase the sales and decrease your expenses, your profit will automatically go up, right? Right. So another way of increasing the ROCE is by decreasing the capital employed. So the company can reduce the capital employed by selling off extra or surplus assets which are not contributing to the profit. Now, we did this above. Capital employed is total assets minus current liabilities. So if you decrease the total assets, then the capital employed will decrease, right? So if you sell off your assets, the capital employed will decrease and the return on capital employed will increase. And then you can just write down some basic details to this and you'll hopefully score 5 marks. This isn't really all that difficult. You just have to keep because he's given you the hint. You just have to find out ways to increase profit and decrease capital employed. So that is going to be this paper. I hope this helped you. If you have any suggestion or questions, please comment down below. If possible, like this video, subscribe, and I'll see you in another video. I'm hoping to make paper 2 in my next video. So thank you for watching, and see ya.